How do you feel with using a collateral loan on the cash surrender value instead of a shareholder loan with a 1-year payback to move money out of a corporation tax-free? So the whole premise behind this question is if you have a permanent life insurance policy inside of a corporation, builds up cash value, you can borrow against it personally. Effectively, you're pulling money out of the corporation, having not paid tax on it. But technically you're not, because you're not actually pulling money out of the corporation. There's just an existing loan, and you have interest payments, and there's other factors involved, but there are no taxes on loans. The other piece of this is this whole idea that if you have a shareholder loan, it does need to be repaid within the year. Otherwise, it's going to be taxed to you as income, just like, taking a dividend out of that corporation. So the whole question becomes, net after all of the fees and potential taxes that you're going to pay by doing this, kind of insurance strategy, are you farther ahead? And the problem that I see with so many of these scenarios, they absolutely do work sometimes, but they're often massively oversold, and we'll deal with the fallouts 5, 10, 20 years later where somebody comes to me and they say, Eli, I got sold this thing years ago. I don't really understand how it works, but he told me that I could just take this policy and then I could pull money out, out of the corporation tax-free. But they didn't really ever actually explain the details. And now we're trying to sell the company, and it's an asset that's in there, and we're having to pull it out of the corporation. Like it's messy, right? Because people can't anticipate exactly how these structures are going to look 30 years down the road, right? There's just no way you could predict it that far in advance. So you just need to be really careful with structures like that, because more frequently than people like to admit, they just absolutely blow up in somebody's face. And so, yeah, it's not something that should be recommended by your average insurance salesperson, right? These should be structured by an accountant or a tax lawyer, kind of well in advance, and understanding, explaining to clients all of the risks associated with that strategy.